Lloyds Bank, who's going to give us an update on the economy. Thank you, Trevor.
Good morning, everyone. Rachel said she was going to be very efficient, and she was. I mean, that's one of the best introductions I've had. None of this fiery stuff about, what your job title is, what the role is, and, what your pedigree is. Just Trevor Williams, here he is. So practitioners, the buck stops there was what I was thinking. I was just saying to Neil, so what does that actually mean? It means that you are the business and everything in it is your responsibility. So I'm going to run through the Lloyds Bank view of the UK economy with a bit of the backdrop which will impact the UK economy. There's lots of stuff happening out there which is impacting the UK. And philosopher Agamemnon had a saying, one of his phrases, drink deep of the well of knowledge, or drink not at all. I love that one because the world is a complex place, and a little knowledge is a dangerous thing. And when I first came up with that phrase, it was because there was lots of press commentary about the way that apparently Vladimir Putin was outwitting President Obama. And I said, well, how is he outwitting President Obama? The Russian economy is heading for recession because of what he's done. The population is dying because of lack of health care, for want of a better way of phrasing it. And they've been isolated, and there's capital flight of 40 billion a year. I mean, he is outwitting him if his plan is to destroy the Russian economy. But I presume that's not his plan, so... just one example of a little knowledge is a dangerous thing. You think you know what's going on, but actually, do you really? So let's look at a couple of these. Oil prices is another one, and what Saudi Arabia is up to with it, and I'll comment on that in a moment too. So, economic outlook for 2015, because I know you don't want to look at 2014, right? We already know how it's panned out, so let's look ahead as much as we can. So here's a summary. And the key points I want to land are these. The US economy is the fastest growing of all of the developed economies with the best prospects for the next few years. That's it. It has solved most of the problems created by the global financial crisis and the Great Recession. So it's deleveraged, it's recapitalized its banks, it has growing productivity, it has a huge energy cost advantage because of its technological change in the area of oil and gas extraction, which allows you to extract the stuff from places that were previously uneconomic. Which, by the way, is this bit about, so what are the Saudis up to, why oil prices falling? Well, it's because supply is going up. That's why. And that's one example where supply is going up and going up a lot. They're self-sufficient now. They consume most of what they produce, yes, but they're now supplying enough to meet their demand for now. But at what price? I'll touch on that in a moment. The UK looks set for steady growth next year. We will not have a recession, barring an act of God, and there are always acts of God. So we can't rule it out. But it's the thing with low probability outcomes. So when I forecast, it's typically, I give bands to the forecast. So it could be that 50% probability is attached to the view that we grow at 2.5% per annum next year. That's it. But there's another 50% which could have varying outcomes. 10% that it goes, maybe 20% that is stronger than that, maybe 10% that is weaker than that, and some other probability that it's somewhere in between those. But low probability event outcomes have high event risk. So if we're wrong, we're going to be really wrong, in other words. But we're pretty sure, based on the conditions in place in the UK at the moment, that we will be able to sustain this growth. Credit conditions are benign. They're correct for the conditions that are in the UK. Growth is well spread. It's the Eurozone that's a problem for the UK because it's our biggest trading bloc. and it is either going to have a recession next year or weak growth. But one thing is pretty certain, it's not going to have strong growth. So it's a risk for us. Monetary policy, they will stay loose, they're going to do more QE, but QE isn't the solution. The supply side reforms is what they need, but it's a lot more difficult to do supply side reform than it is to do demand type measures. And so they're in a liquidity trap, as we call it. You can cut interest rates as much as you like. If people don't want to borrow because they're too highly in debt, they don't borrow, they pay off debt instead. So you don't get the demand effect and you don't get growth. That's it in a nutshell. That's why monetary loosening in Europe hasn't worked. The Japanese economy is facing its own challenge, mainly of demographics, a shrinking working age population. They're depopulating, but they're rich, so they don't want to change. And the wrenching change, which might arrest the demographics, is something that they will not countenance, which is large-scale migration, probably from Indonesia, or dare one say it to the Japanese, Korea. So it's just not going to happen. The two largest populations, India and China, their economies are still growing, with reforms in place in China, with reforms in place in India, which will sustain growth at between 4 and 7% in each of those economies, which is good news. Russia's economy, as I said, is already in big trouble, particularly with the collapse in oil prices, which is where some think that there's some kind of Machiavellian plot, Machiavellian plot one, that the reason why oil prices are low is because the advanced Western economies are conspiring with the Saudis to drive down our oil prices, to stop his military adventures in Eastern Europe. Machiavellian plot two is that the Saudis want low oil prices so they can make the shale gas producers and oil gas producers in the US uneconomic and drive them out of business, and it will drive up prices. I don't believe in plots like that because they just unravel at this kind of scale. It's the supply of the stuff which is driving down the price, and they need the money, that's why they're pumping the oil. Brazil steering a middling course. So the big risks to the world economy are these. One is that when the US raises interest rates next year as a result of its success in solving its economic problem, it could create problems for the rest of the world because policy will be diverging between the US and the UK on the one hand, and Europe and Japan on the other, where they'll be loosening. So what happens in financial markets? We don't know, is the answer. The emerging markets could face a backlash from some of that. Capital could leave them and go to the US. And so there could be volatility in these economies as a consequence of that. The euro area will remain in a period of extremely slow growth, potentially disinflation, which isn't falling prices. Deflation is where prices fall in absolute terms. Disinflation is just where inflation remains very low, which is what they've got. Because figures yesterday for Germany, for instance, showed that inflation was 0.5% per annum. That's a very low rate of inflation. The problem with low inflation, by the way, when you have high debt, or deflation will be worse, of course, because if you have high debt and you have deflation, debt goes up. Very bad news. When your debt burden increases, that means you spend less, save more, economic recovery doesn't happen. Disinflation doesn't do quite as badly, but it doesn't erode the value of your outstanding debt enough. So it all augurs ill for the euro area. China, potential for bumpy landing. I give that very low risk. Bigger risk attached to Abenomics. Shinzo Abe, the Premier of Japan, which is called a snap election, by the way. He had a mandate in 2012 to do his three arrows of fiscal reform, monetary reform, and structural reform. We think the third one actually is not even, well, it isn't an arrow, it's more like a dart, because it's just not significant enough. But he's pulling the monetary and the fiscal levers. But he raised VAT in order to get some cash into the authorities, given the loosening of fiscal policy stance so much, and it created a slump in the economy, and it contracted by 2% in Q3, right? So it's called a snap election for December to renew his mandate, although it doesn't have to call until 2016. It's just politics. it won't solve his problem at all, which is that it might not work, what he's doing. It could just leave Japan more indebted in a few years' time. With no underlying solving of the underlying problems that they have, which, as I said, are demographically related, and in fact, how do you grow when you have a shrinking in your working age population? Very, very difficult. Which has its own implications for others that are aging too. Commodity prices, well, actually, the risk is low commodity prices now, not high commodity prices. We're in for a period of the so-called super cycle is over. Decrease in headline inflation, reduction in purchasing power and consumption and so on. That's the risk generated by having oil prices too low. I think it's actually good news for the world economy. For every $10 fall in the oil price, global growth goes up by 0.2. Given it's fallen about 35%, it implies a rise in global growth of 0.7 in the year ahead. That's not bad news. That's good news. So let me focus on the UK economic trends now that we've looked quickly at the global backdrop. So what faces us in the UK? Well, we're growing. We've had 7 consecutive quarters of growth, and we're set for more growth over the next few years. The economy is now bigger than it was in 2008, just prior to the onset of the financial crisis stroke Great Recession. But the recovery, compared to the recoveries in the 1990s and 1980s, is weaker. As you can see, if you look at the path of this recovery, in terms of the number of quarters that it's taken for growth to get back above where it was before the recession started. That's a litmus test, really, of the severity of the downturn. So it's lasted almost twice as long. And it was more severe. And if you have a severe recession, then growth, in percentage terms, tends to bounce back more quickly. But that hasn't happened either. And the reason, of course, is weak balance sheets, because the crisis was one which was partly precipitated by high levels of household, corporate, and ultimately government debt, which means that you have to reduce your levels of debt. You don't respond as aggressively as you do in a normal cycle to cuts in interest rates. Because remember, the point of cutting interest rates is to reduce the cost of borrowing, is to give income back to those who pay debt, and they're much more likely, therefore, to spend a higher proportion of their income. But when they're also repaying debt, when they're highly leveraged, it means you don't get that effect on spending that you would otherwise get. So that is why the recovery has taken rather longer. Also, of course, it's damaged the balance sheets of the lenders, who also need to repair them before they're willing to lend. And the authorities' balance sheets have been pretty damaged too by the oil crisis. That's what slowed our recovery, but it hasn't prevented the recovery, and that's the real good news. Whereas in Europe, it's preventing the recovery from taking place. The reason is we've had structural reform. We'll come back to that in a moment. The recovery is entrenched across all sectors of the economy: services, manufacturing, construction. They're all in positive territory. So it isn't a narrowly based recovery, which would clearly be more worrying. It's spread across all of the major sectors of the UK. Of course, services is higher than it was in 2008 by about nearly 6%. Manufacturing is still about 5% below where it was in 2008. Construction is about 11% below where it was in 2008. In other words, there's scope for us to continue to grow before hitting some sort of capacity ceiling, isn't it, implicitly in this. This is one of the reasons why we should expect to be able to grow at 2.5% or so for the next couple of years, without running up against inflation constraints. When you use up spare capacity, inflation starts to build because you're demanding more than your ability to supply it, and so sellers can widen their margins. It's also spread across all of the regions and nations of the UK. By the way, I recommend if you ever go to Scotland, you're shown a chart of regions of the UK, you take off regions and put nations and regions of England, okay? I did once do that, regions of the UK, and Scotland is not a region, it's a nation. I was quick-witted enough, though, to point out the fact that it's not as bad as George W. Bush on a tour of Latin America, when in Brazil he said, it's fantastic to be in Bolivia. Apparently the Bolivians were ecstatic, the Brazilians weren't so happy. What this slide shows is two things. Purchasing managers' indices measure activity of those that are buying inputs into the production process. So the slide on your left, whenever these indices are above 50, they suggest that there's an expansion in activity taking place. And you can see they're well above 50 in all parts of the UK, regions and nations, of course. And employment trends are also above 50. So not only is it growing, but the growth is translating into demand for labour. So that's good news, because it's well entrenched across all parts of the UK. I mean, there's an article the other day which looked at how Wales was growing so well, and that its unemployment rate was at 6.2%, only a smidgen above the UK average. And this is a sign that the recovery that we're seeing is well entrenched across all parts of the United Kingdom. So it's now 3.4% above its 2008 peak. How does our recovery compare with recoveries in other parts of the world where they had a recession? Well, only the US economy is outpacing the UK. Germany did not have as deep a recession, and so its recovery was rather more rapid too, because it didn't have the balance sheet problem. There's a reason why Aldi and Lidl come from Germany. They're very frugal in their spending habits, which is part of the problem actually for the trading countries locked into monetary union with them, because it's very difficult to export to the Germans, because A, they've got such high productivity, they're so strong across the range of goods and services, it's hard to find a competitive niche against them for the countries locked in with them. Whereas if you're locked into trading union with the US, you know they're going to consume a lot, and they're going to be buying a lot of your stuff. It doesn't happen with the Germans, which is the problem that some countries have locked into monetary union with them. Now, here's the reasons why recovery is taking place. Finances are in much better shape. And I'm sure this will adhere to your professional instincts. If you look at the balance sheet of the corporate sector, you can see that their financial surplus has gone up. Yes, it's off the peak, but it's still well in positive territory. They're accumulating cash. The deposits that they're able to make into the UK banking system continues to rise. That's also telling us, by the way, Pat, that they're not spending enough. The flip side of that is maybe investment spending could be stronger, which is one of the worrying bits which did come out of the Q3 detailed figures, which show that quarter-on-quarter investment spending by companies fell in the UK. It was up 9% year over year, though, which is good news, but it didn't grow in the quarter. That may be just one of those quirks in the quarterly data, because it had grown quite strongly in the previous quarters. You can't expect these things to grow strongly every quarter. But the balance sheet of the corporate sector is much stronger. And confidence in their profitability has returned, which is on your left-hand side. These are all important things because they correlate well with their willingness to hire and with their willingness to invest in plant and machinery, which drives growth. And demand uncertainty was one of the key factors that held them back from investing. Now demand uncertainty has fallen to very low levels from the very high levels that they were a few years ago. They're much more willing to spend and invest, which we saw coming through into the figures. So we know that there is a link, a real genuine link between surveys like this and outcomes in real economic terms. So there's plenty of reasons why firms should invest. That's the summation of that bit. And they are investing, but not enough compared with the extent to which investment spend is below its 2008 peak. And we have a problem in the UK with productivity. The flip side of hiring so many people and not investing in plant and machinery is that our productivity growth is awful. And in the end, in the long run, Keynes, I said we're all betting in the long run, but it is made up of a series of short runs. in the long run, productivity drives living standards. We get richer because we do what we do by adding value to stuff. That's how living standards go up. And so productivity must increase in the medium term. It's how we do that, which is a different challenge in some respects. It's about education and skills and stuff like that. So a little knowledge is a dangerous thing that comes out when you look at newspaper headlines which say contradictory things on the surface, such as the UK has a shortage of skilled labour, yet youth unemployment stands at record highs. How can that be? If you live in Clacton, you know, you're twice as likely to be unemployed compared with the next region. All that sort of stuff is going on all at the same time. I mean, the region next door, you move into the region next door, you're twice as likely to get a job. Why don't you do that then? Well, I'm not going to go there with, you know, Farage and Clacton. I'm just saying, you know, that the reason why they don't move there, of course, is because it's the skill set. That's the difference, right? You know, can you do those jobs? Also, are you willing to do those jobs? Because you know, there's unskilled jobs too, but they pay close to the minimum wage. So it's a complicated world, in other words, and you've got to look at things in very detail sometimes to get a sense of what's going on. Now, capacity utilization determines to some extent the pressure that forces firms to invest. I mean, if you're running at full capacity, you know, if you as a sole practitioner just couldn't cope with the amount of work that you're getting, which is a good situation to be in, of course, you might hire someone to increase your capacity. You know, get some new busy calculator. I'm kidding, but you know what I mean. And so capacity constraints are now beginning to bite somewhat more. And so firms are much more willing to invest at that frontier when the demand for their goods and services is such that they're running at close to full capacity, and that's beginning to happen as well. And so what's happening on the consumer side? Because remember, businesses are willing to invest and spend and hire when there's demand for their products. And so it must be that on the other side of the ledger, the demand for their goods and services is going up. So let's look at what consumers are doing, because that's what ultimately drives growth in the UK, because 2/3 of our GDP, when measured in terms of expenditure, comes from consumer spending. And consumer confidence, as you can see, has shot up from the abysmal lows in 2008-09 to around flat positive territory at the moment, which, by the way, is consistent with growth around 2.5% in consumer spending when it's at the zero line. So we're such a pessimistic lot on average that a zero is actually quite good news. Pessimists are balancing the optimists. And so the household savings ratio, which correlates to confidence, the less confident you are, the more likely you are to save. Of course, if you can save. And so the savings rate shot up during the economic downturn as people wanted to reduce their debts because they were worried about being unemployed, because they were worried about servicing the debt, because they were worried about losing their homes, and so on. And it's come off only a little bit, but it has come off, which is a sign of higher consumer confidence. The other part of the story for households is that they feel a bit wealthier. So one of the side effects of quantitative easing is that money flows into financial assets, including equity prices, bond yields tend to fall, and house prices tend to go up. And lo and behold, house prices have gone up. And those that have a home feel much happier about having it. Those who can get one start to think hard about whether they should get on the ladder while they can, and low interest rates encourages them to do so, as does, of course, the scheme called Help to Buy, which, as its name implies, is helping people to buy a home. And so house prices started to rise, housing completions and starts have gone up somewhat. Housing completions and starts, by the way, have a long way to go. We don't build enough homes in the UK, which is why we did not have a collapse in house prices. NIMBYism is alive and well and living somewhere near you. We have household formation at around 220,000 per year yet we only build about 160,000 homes a year at best, and we've been doing this undersupply for at least a decade. So there's a serious, actually, housing shortage in the UK. Well, in areas where people want to live, of course. I mean, anybody from Manchester here? I'm going to get lynched if I keep this up. So what's happening to borrowing? You know, sometimes you hear house prices are high, there's boom going. There's no boom going on. House price growth, mortgage terms, is rising at 1.7% per annum. That is not a boom in house price in mortgage lending. There's no irresponsible borrowing or irresponsible lending going on. The rise that's taking place in consumer borrowing, which is made up of credit cards, overdrafts, personal loans for cars and holidays and stuff like that, is growing at high single digits, currently growing at around 8% or so. But it's because for 4 years, people are repaying all of it, as much of that debt as possible. So there's a bit of catch-up, a return to long-run mean reversion taking place. Actually, it shows that the borrowing structure in the UK is still quite conservative. And house prices across the UK as a whole are still, in real terms, below their long-run average. Most of the fast increase in prices have taken place in London, which is an international market, which is very much a barometer of the health of the UK as a whole. Outside of that, house prices have been much more restrained, and indeed, house prices have fallen back in London recently, and the rest of the UK tends to follow the trends set by house prices in London, and so we're looking at 3 to 5% growth in house prices next year, after what was 17% in London and about 11% in the UK on average. So wealth effects have helped to encourage households to spend. The two things to bear in mind when regards to, so what happens next? What happens to policy? What happens to inflation? What's going to happen maybe in the autumn statement on the 3rd of December? Well, this sort of tells you, the story is governments still spend more than they earn in revenue from you and me. We earn, they tax. And government spending is still running ahead of it, which is why we have a fiscal deficit. So we're borrowing to bridge the gap. The budget deficit is the year-to-year borrowing to bridge that gap. Debt, of course, is how much you're adding to the stock of existing debt that you have. And so our standing stock of debt is 1.45 trillion. Remember, we generate about 1.6 trillion a year in annual income in the UK as a country. So we're close to 100%, we're about 80%. The fiscal deficit, for long as it continues, it means that we're adding to the stock of existing debt. So we want to get to the point where it's zero, and you're no longer adding to the stock of outstanding debt. Here's the good news. International investors in the UK believe we can do it, which is why our borrowing costs are 2% for 10-year money. 10-year money, 2%. That's got to be a sign of confidence that the authorities will actually get the budget deficit down. So the autumn statement must indicate that in the medium term, that deficit comes down to zero and the stock of debt stops rising. So it means that there will be spending cuts, the comprehensive spending review, in the next parliament. You'll notice that actually over the last few years, government spending has not actually fallen on average over the period in terms of its impact on GDP. There has been restraint on spending, definitely, but the real cuts are to come in the next parliament, consistently. So there's some tough decisions to be made around where public spending is going to go and how we're going to do that. But do it, we must. Because even with doing it, it's possible that the rating agencies could mark down UK debt. It's already been marked down from AAA, but it might be marked lower after the autumn statement, depending on what's in it. So there's no room to go on a spending splurge, that's for sure, or tax cutting. Although there is scope to reform tax, to make it simpler, and then actually end up with even some more money to spend. But That's a tough, bold reform ask of a government 6 months away from a general election. They tend not to do bold stuff like that 6 months ahead of a general election where they're uncertain about whether or not they'll be the largest party, especially with the arithmetic of the way the boundaries are and the shifts in population that's taken place over the last decade or so. We also have a current account deficit, which is the flip side of my saying earlier that we don't invest enough. So you end up with a current account deficit because money comes into the UK so that we can do this borrowing and spending that we're doing. And when you do that, you must have a current account deficit, by definition. Current account and capital account, it equates to savings, investment imbalance domestically. And it's a symptom of the low productivity that we have. So to make it a real, think about the huge amounts of investment required, for instance, in nuclear electricity generating capacity. 10 plants come off stream. Each plant costs about 8 to 10 billion a pop. You can see that adds up to quite a lot of money. Given the constraints of public spending, where is it coming from? It's got to come from abroad. It's got to therefore be attractive to invest in the UK, which is why we need to keep our policy as we have it open to foreign investment and talent and so on. But we're running a current account deficit, not a worrying one. It's about 5% of GDP. However, we have another kind of test of a country's ability to be able to run deficits, which is that 10% is like a magic threshold. Investors start to worry a bit when your total financing costs are above 10%. And if you add our fiscal deficit of over 5% or current account deficit of 5%, it's above 10%, which usually puts downward pressure on your currency. So it's why our forecast for the currency is that it will depreciate because those investing in the UK must see a cheapening of assets and higher returns for their investment. And this is how it will work out. The good news is that even though we have a current account deficit, the UK is internationally competitive. It is a good place to locate and export, which is what happens, of course. And foreign firms that locate in the UK, they tend to be more profitable, they tend to be higher productivity, they tend to pay more, all of that stuff. And so, it might not play well in elections, but it's actually what's going on. Selling it is a different point, but it's highly competitive. And so the UK is able to pay its way in the world because of that flexibility of the labour force, which is shown more starkly here, where that wages have not responded to the recovery, have they? So wage growth in real terms is actually 0. Inflation is 1.3, and the growth in average weekly earnings was 1.3% higher than the year before. So there's no growth in real earnings going on. And actually, if you look over the period since the recession, real wages have fallen by 8%. That's how the UK has managed to remain competitive. And the reason why consumer spending has gone up is because employment has gone up sufficiently to mean that total pay has increased. And if you're highly skilled, then of course you're more productive, and so nominal pay is higher, but because it's paid for by productivity, it doesn't disturb this inflation profile. And the squeeze is on the public sector, where public sector pay is actually negative, and private sector pay is positive. So there is definitely a squeeze on the public sector going on, and that squeeze, given what we said about the comprehensive spending review, is likely to be maintained over the next few years. The economy is beginning to slow somewhat, which isn't bad news, by the way, because it means inflation is likely to remain low and policy can stay looser for longer. And the loss of momentum is only marginal. And so it's the PMIs again, they come off the boil. So services PMIs are no longer over 60, they're 58, but that's still well above the 50 mark. Service construction PMI is mid-60s. Manufacturing is around 53.5. So they're growing, but somewhat more slowly. And that isn't, as I said, bad news, particularly if you look at the shape of growth, which is both partly consumer spending, but also investment spending. So this is contributions to growth, given their share of GDP and given their growth rate. And so we've got 3% annual growth, of which 1.5% is roughly coming from consumer spending and 1.5% from business investment, which is actually a nice balanced growth. At least it was in Q2. Q3 wasn't as good. Net trade is negative, so we're importing more than we're exporting. And here's the interesting thing, government consumption spending as a share of GDP is still positive. So in other words, we talk about austerity, but actually, government spending is not a net drag on the economy at all. It's still a net positive on the economy. And so the offset to some of the fiscal tightening that's going to come has got to be looser monetary policy. Inflation is going to remain low over the next few years, partly because of what's happening to global food and commodity prices, and also because we do have the capacity to grow without generating inflation because we still have some spare capacity. We talked about capacity in construction, we talked about the capacity in manufacturing for the levels to get back where they were in 2008. Now, when I put this together, oil prices, Brent crude had fallen towards $90 a barrel. It's now fallen below $80 a barrel. Lower oil prices gives income to consumers and takes it from producers. So if you're selling, you lose income, but if you bought oil, then you're gaining. So it's like a tax cut for consumers. It's actually good news for consumer spending in the economy. It also keeps inflation low, which is good news too, because it means interest rates can stay lower for longer. And this is exactly what we expect, lower for longer for interest rates. We're in lower for longer. This is lower for longer. And so this is an interest rate which are rock bottom in Japan, the US, the Euro area, and the UK. The ECB is loosening policy. The Bank of Japan is loosening policy. US has stopped quantitative easing. The UK stopped quantitative easing in 2012. It didn't add to QE. It hasn't sold any of the stuff it bought back, but it didn't buy any more from November 2012. Still standing at 375 billion. So interest rates will remain at a record low. Bank of England was founded by a Scotsman, by the way, in 1694, and rates the lowest they've been since then. My son said he didn't think I was that old. I said I wasn't. We're going to likely see a 6-year low in inflation. Next year is the 6th anniversary of rates being at 0.5%, and financial markets are now betting that there will be no rate rise in the UK until November next year. That's when the expectation is such that it implies a 32 basis point increase in bank rate, which is a quarter of a point increase. They may be wrong about that because it shifts, but looks like second half of the year rather than first half of the year. If things go wrong, it won't be in 2015 either. So the good news, as I said, is that low rates are good for those with debt. We have a record low level of mortgage repossessions in the UK, a record low level of corporate defaults. It's got to be good news that rates stay low for long enough for the economy to recover sufficiently to be able to withstand a rate hike. So it isn't bad news at all. This is our long-term forecast. Growth settles at around 2 to 2.5% per annum. Our long-term trend is around 2.2. All forecast models come back to the long-run average. They're mean reverting by the very structure of these statistics. The statistical methodologies involved in all of these forecasts. Any number crunching you do always comes back to the mean eventually as the impulses we push it away from the mean fade. So I don't know how much it means. I mean, I don't know if I think growth will actually be 2.2% in 2018. I suspect it might not be, but it's the best guess for the moment. And so the Bank of England itself said rate rises will be low and modest and moderate, and they'll only do so when the economy warrants it. Now, the legal team were very worried about how sure I was about these forecasts and asked me to add the disclaimer. And John Maynard Keynes once said when confronted by someone who said, every time I see you, change your forecast. He says, well, sir, when the facts change, I tend to change my conclusions. So I like to be held to the same standard. Thank you very much for listening. We have 2 roving mics, and I think we have time for about 5 minutes of questions, if you so wish. The gentleman over here in the middle, and the gentleman here at the front, just to anticipate the next question. We'll do 2 ahead, and then I'll come to you, sir, in the 5th row. So the gentleman over there in the 3rd row. That gentleman over there, he had his hand up first, sir, so we'll...
Very interesting, economically speaking, but why is our Premier thinking of abandoning ship?
Why, what, sorry?
The Prime Minister.
Why is he thinking of abandoning ship? Is he thinking of abandoning ship?
Yes, he was a few weeks ago, yes.
I'm an economist, not a politician. I have no idea.
He has got
I'd rather not venture a guess.
Well,
Maybe it's politics. He's pretending. I don't know.
I don't know. Maybe that he seems to have thought that we are facing a bit of a economic downturn, and
Well, he didn't say downturn. He just said that the red lights are, to quote, the red lights are flashing on the dashboard of the global economy. He didn't say the UK.
but don't you think? Sorry, don't you think that the captain of the ship should not be saying that?
Well, there is tension between being honest and being Panglossian, which is foolishly optimistic. And maybe it was politics too. Maybe, you know, they don't want things to look too rosy because it'll mean don't worry about the economy, we let Labour. And they want to say we are the best stewards of the economy. There's different ways one can rationalise it. The best person to rationalise that comment is definitely David Cameron.
The other question I've got is, you indicated that interest rates being low are good for us in this economy, but the disadvantage of this is obviously that people are not going to save, and if you don't save, the future's not going to be very good, and especially with the demographic population aging considerably in this country. Yeah,
I mean, again, it's a balance to be struck between getting recovery going, so that when you save, you've got something to spend the money on. And the point of low interest rates, yes, I'm afraid, is to punish savers and to benefit those that spend and drive growth. That is the plan. And I think it's probably the best plan given the circumstances for the whole economy. Yes, sir. And if the mic could go to the gentleman over there, please, in the 5th row, on the end, 3rd from the end. Yes.
You were saying about the conspiracy about these oil prices.
Yep.
You mentioned 2 things. One was about the Russia, that the Western Union was trying to, the West Europe been trying to conspire against them.
Yeah.
And then you said about the second part that the second theory was that it was trying, the Saudis or the OPECs were trying to
drive down oil prices so that they make
down, so that
US
the
production uneconomic.
USA will go down.
Yeah.
Isn't that the first one I'm okay, but the second part I think is not really correct because they are trying to do that.
Well, look, I did say I don't believe in Machiavellian theories, though, didn't I? Yeah, I did. Yeah, I don't believe any of either of them. I believe in accidents.
But everybody says that is part of the equation. I mean, that is why what they are doing. They intentionally know that they need to keep the prices down so that the US does not produce these shale gas. And
like I said, I don't actually believe that. I think that the reason why they're really doing it is because they need the money. And there's good reasons why Saudi Arabia needs the money.
But they will still get the money unless you need but higher prices or the.
Well, it isn't clear to what extent they'd have to cut production to make any difference to this oil price. I mean, they might have to cut production so much they halve their revenue. Why risk it when you need the money? And remember, they're spending a lot of money down there in various places, Syria and Iraq, Libya, and of course, I think they've got a lot to answer for in other parts of the way that Saudi money ends up in places where it shouldn't. but that's a different point. And so the next question comes from the gentleman in the 5th row, and then there's a gentleman in the 3rd row who's also got his hand up. So if we get that mic to that gentleman. So, sir.
Sorry, Trevor. Going back to my GCSE economics. Your supply of labour would depend on your demand. Now, basically, I've been hearing how brilliant the growth is in England, in the UK, but how much of this really growth, I mean, it's your fuel into employment. Now, if you see, most of it is on zero-hour contract and all those sort of petty little things. Really, is it really sustainable? Now, I mean, Bank of England doesn't really want to fiddle around with your interest rates, because that would mess up your demand. So I'm really beginning to think, really, is this growth really real, or is it phony?
It's real growth. These are real numbers. These are adjusted for changes in pricing. There's volume. So there's volume growth taking on, no question. The point you're making is about who benefits and who doesn't. As I pointed out, the higher skilled you are, the more you benefit. You won't be on 0 hours contracts or on minimum wage if you have a skill which is currently in demand. And we have a huge number of areas where there's serious skill shortages in the UK. I mean, you can't get an engineer for love nor money. For example, construction workers, big shortage. You know, big projects going on, not enough. And so the question that I alluded to earlier is, why is it that it coexists with pockets of higher unemployment? And it's about education and skills and technical colleges and all of those things which are hard to fix in the very short term. So it is genuine growth, and we may argue about the fact that some people are low pay, but being in work, even at low pay, has positive benefits for society. You don't have to get up in the morning, you know, for a start, and you know, have to put, you know, you've got to work to put bread on the table. And those sorts of things. You know, you think of areas and whole estates where people, nobody works. It isn't good. And also the other thing to note is there's a lot of transition. It's transitory. People on low pay typically are people that are going to be doing other stuff. They're not necessarily locked into low pay for their entire life. And so it's about the opportunities to get out of that society provides people by allowing them to train and retrain and so on and so forth. So the flexibility of the labour force definitely means we are recovering. And that's good news, because you can then spend some of that income in addressing some of the structural problems that you still have, such as low productivity, which is based on too low skills in some parts, in some sectors of the economy. So you know, for example, that last year the UK turned out only something like, well, take Imperials, for example.